I'd like to begin with a review of the basics because as long as I've been in the business, and that's for more than 30 years, and I've been using the wave principle the entire time, I find that a review is always helpful and is something I do on a regular basis. And so what has drawn me to the wave principle and what has kept me using the wave principle? Because in my experiences, I've seen a number of people jump from method to method. And there's nothing wrong with that, but at some point, you do need to settle on one or a handful of methods. And I learned that early. When I worked on the commodity exchange in New York, I found, and I was just a clerk there at the time, but I was hired because I knew about the wave principle. So I was standing on the floor with the floor traders for the firm that had hired me and advising them on where gold, silver, oil, whatnot was headed next. Now we're looking at a very short time frame. These were day traders that never took a position home, could be in and out of positions in moments or minutes. An hour would probably be way too long for them. And what has drawn me was the possibility to use the wave principle on all degrees of trend, which means all time frames. Personally, I might like to look at a daily chart for a sense of perspective and finding the larger trend. For their part, scalping in and out, they just want to know where it might be going over the next few minutes, and I was often able to help with that. And it's the perspective on the market's general position and outlook that was valuable to both me and my longer-term view and to those traders I was working with and their shorter-term view. But what do we mean when we talk about the market's general position and outlook? Well, in the 30s, Ralph Nelson Elliott discovered that the markets move in patterns, and those patterns are repetitive in form, but not necessarily time or amplitude. And both of the parts of this statement are important. Repetitive in form means that the markets move in predetermined set patterns. So if you can find out where you are within a set pattern, you have an idea, a roadmap even, of what you can expect going forward. So to me, that was critical. It's sort of like when you embark on a trip and you look at a map, and now you'd have to think back perhaps to when we didn't have apps on our phones to tell us where to go or built into our cars, but looking at an old-fashioned paper map, you might look at it and find several ways you could go, and then you determine which one was best for you, depending on your goals for the trip. And as you drove along, you would follow where you were on that roadmap, so you knew where the next turn would be. Same thing in the markets, at least that's the way I think about it. So it's important to know where you are within this repetitive form. Now, what about time or amplitude? Well, that means that these patterns unfold at different degrees of trend. So we could look at a daily chart and find, say, a triangle pattern. And I'll get to that in just a little bit, what that means. But I could drop down to a 15-minute chart, 30-minute chart, 60-minute chart, and also see a smaller version of that triangle pattern. And one of the things that drew me and keeps me with the wave principle is that the meaning, the message that the market is sending when it traces out such a pattern, say a triangle, is the same, whether I see it on a 15-minute chart or I see it on a daily chart or even a weekly chart for that matter. So I can take the same basic information I'm using on a day-to-day basis and apply it to all degrees of trend. So whether I'm a short-term person in and out of the market in hours or days, or I'm a longer-term position type investor, and I'm in and out of the market in weeks, months, or perhaps even more, depending on what type of asset we're working with. So what do I mean then? Let's start with the form. What do we mean? Well, this is the idealized Elliott wave progression. This would be what you'd expect to see in a bull market. I'm certain you have seen this many times, but again, I think it's critical to go back to basics often, and I do so, as I said, regularly, at least on an annual basis, you will find me reviewing the material that I studied when I started this journey many years ago. So we have this progression. We have 5-wave advances, 3-wave setbacks, again, within a bull trend situation. 5-wave movements, which we often call motive or impulsive, dictate the direction of the trend at one larger degree. We label those waves 1 through 5. Corrections end after 3 waves, and we use letters A, B, C. So when you see a 5-wave movement, that's in the direction of the trend at larger degree. When we see a 3-wave movement, that's a correction within a larger movement. In this case, it's a pullback, so we're within a rally phase. I'll go over some of the reasons why we think that the market follows this pattern in a moment, but before I do, let's move on to corrective patterns, because those are the most difficult. When you're looking at an impulsive rally, the 1 through 5, it usually becomes quite obvious that it's an impulsive move. The market finds it very easy, if we're in a bull market, very easy to advance. It wants to advance. It's ready to advance, and it usually does so fairly quickly, rapidly. It's obvious what the trend is. When you get into a corrective phase, the market becomes choppy, overlapping. Think of lots of adjectives along those lines, and a market gets much more difficult to follow. That's a key point to remember. Within corrections, the market is difficult to follow. And there's a good reason for that. Because when you're in a corrective phase, unlike the impulsive phase, which is there's usually a single path, it's a 5-wave movement, there is more than one corrective pattern available. Here we show you 4. There are others, but they fit within these 4. We have first the common zigzag pattern, perhaps the most common corrective pattern. It's simple, it's sharp against the trend. It unfolds in first 5 waves to the downside, which signals that the trend at one larger degree is at least temporarily rolling over to the downside. Again, all this discussion is in a bull market situation. We could flip it all over if we were talking a bear market. But a bull market situation, market's been advancing, whatever market it might be, and on a small degree, we have a 5-wave setback. That's a signal that if that decline does not complete a pattern, that it is the first leg of a larger correction or some pattern to the downside. It's followed by a 3-wave rebound. Well, 3-wave movements, is already covered, are corrective. So we have, if we're expecting a correction, because we know where we are in that larger roadmap, say we believe we're in a wave 2, we're expecting a setback in 3 waves that ends after 3 waves, and we'd have the first 2 in place, wave A and B. Well, since we have a 5 decline followed by a 3-wave rebound, we can categorize the correction as a zigzag, because they unfold as 5, 3, 5, and expect a second 5-wave decline in wave C. It will complete the correction, and then from its low, the larger bull trend could resume. Fairly straightforward. Now, the flat is a whole different animal. It starts with a 3-wave setback. So you're thinking at that point, the correction could be over. And it's true. It could be. But there are other tools we use, which we'll cover later, and you're probably already familiar with, that would suggest that that's a fairly mild correction. It's shallow. It's unusually shallow. So unless the underlying bull trend is so strong, this might be just the first leg of a larger corrective pattern. In this case, one of the possibilities would be a flat correction. Now you can see in here, wave B is also in 3 waves. In this illustration, it exceeds the origin of wave A, so we would call it an expanded flat. A regular flat, wave B, would form a double top, coming within a few pips either side of the origin of wave A. So we'd have a 3, the initial setback, followed by a 3, the second leg of the correction, wave B. And then to finish the flat, we would look for a 5-wave decline in wave C. That decline ordinarily will dip beneath the end of wave A. Later, we'll talk about some targeting methods. But for now, we're just talking about a flat, which is a 3-3-5 pattern. That is, wave A unfolds on 3 waves, wave B as 3 waves, and depending on whether it's a regular flat or an expanded flat, wave B will either form a double top or even go to new high ground before we have a 5-wave decline in wave C. Third, we have a triangle. I see a fair number of these, one of my favorite patterns, and we'll discuss that later. And in this case, we're showing it as in a bear market situation. You can see by the dashed lines, whatever market we might be talking about was falling into the origin of the triangle. What a triangle is, what Elliott referred to it as a hesitation within the larger trend. It's a hesitation because, as you can tell, it moves in a sideways fashion. Each subwave, which we label A, B, C, D, E, unfolds in 3 waves. That's important. No 5s in here, in 3s. In this illustration, wave B moved beyond the origin of wave A, as we saw in the flat. There are cases where it would not do that. The key, as always, is market structure. If wave B maintains its 3-wave shape, then we see it as a correction or part, in this case, part of a larger corrective pattern. What separates the triangle from the flat is what happens next. We have a rally. It unfolds or ends after 3 waves, and in the case of a contracting variety of triangle, it would end beneath, in the bearish case, or within the end of wave A. And then there would be another 3-wave movement, D, which would end, in this case, above the top of wave B, followed by another 3-wave movement, the 5th, wave E, which would end beneath the end of wave C. If you connected A and C with a trend line and B and D in a contracting variety triangle, those lines are going to converge. There is another variety of triangle, an expanding triangle, very rare, and that is where wave C in 3 waves would move beyond the end of wave A. Wave D would move in 3 waves beyond the end of wave B, and wave E in 3 waves would end beyond the end of wave C. Quite a rare pattern. I've counted it only a handful of times, so I usually do not look for it, but it is a pattern that you need to keep in mind. It is a different variety of a triangle. Finally, much more complicated is what we call a combination. In this example, we're showing it as a flat, being the first part of a correction, and correction could be over there, but for some reason it is not. We have another corrective pattern. It could take the form of a zigzag, flat, or a triangle. It's any 3. We label it as an X. And then afterwards, we have a different corrective pattern from the first one. So in this case, the first one was a flat. We followed it with a zigzag X wave, and now we have a triangle. But we have 3 other classifications of corrective patterns, and you can mix and match those to form a combination. Sometimes the market just needs more time to finish a correction, so a larger pause within the trend. Triangles are good for that. Sometimes the market, if a triangle is not unfolding, we'll see some sort of combination. Now, a combination would not have a zigzag followed by an X wave and then another zigzag. We would simply call that a double zigzag. All right, so we want the first pattern and the last pattern, the third corrective pattern in this case, to be different. It is possible even to have another X wave and a third separate corrective pattern unfold. Very rare to see that, though. What you want to keep track of are the three you see along the top here, the zigzag, the flat, and the triangle. And I say that because the combination consists of those three. And at each point, when you can see the completion of a corrective pattern, you might be looking at the end of the correction, and you must prepare for the resumption of that larger trend, whatever it should be. Now, I mentioned earlier we talk a little bit, and I'm going to get into this more in a separate video, but we would talk a little bit about why this progression, the Elliott wave progressions unfold, why these patterns occur. Now, we believe that market sentiment is what moves price. A lot depends on whether people, and I mean large groups of people, are optimistic or pessimistic. So if you're optimistic and some bad news comes out, you're more likely to kind of sweep it under the carpet, so to speak. If things were different and the general mood of the market was negative and bad news came out, they'd probably exaggerate the price movement that would follow that news. They put more emphasis on that news. But in the case of when things are when people are optimistic, current bad news, we sweep it under the rug because we're talking about the reporting of a company. They miss their earnings or they just barely meet earnings. That's not good. If we were in a bad mood, we would probably sell the stock off because of that. But because we're optimistic, we'll sweep that under the rug and look to future earnings. Oh, well, they think next quarter is going to be better, or 2 quarters down the road is going to be even better. So I'm really interested in that and not what just happened. What we focus on changes based on how optimistic or pessimistic we are, and we always lie somewhere in between extreme optimism and extreme negative feelings. Okay, so let's start. Let's say a market has been falling for quite some time. It puts in a bottom. We'll call that, and it starts a rebound. We call that wave one. And all of this, you can read this if you want to pause and read these explanations. I'm going to go through how I sort of look at it. So we see this rebound occur. We call it wave one. Most, given the larger trend previous, will suggest that that's just a rebound within a larger and ongoing decline. Our first hint that something else is going on is that wave one will unfold in 5 subwaves. I mean 5 waves at lower degree. It tells us that it's just the first leg of something larger to the upside. Remember, think of the corrective patterns. Even if it's a zigzag, and since it's in 5, it would be a zigzag, it would only be wave A. Now, in this case, we're talking about a emerging bull trends. We're calling it wave one. The crowd is going to see it. Most of the crowd is going to see it as a rebound, a correction within the ongoing bear trend. So when wave 2 comes along, that fits their thinking, and they'll start selling it because it's that rebound created an opportunity. So second waves are often quite deep, but as a correction, it should end after 3 waves. Say it's a zigzag. It'd be a 3-wave movement, 5, 3, 5. Because the crowd is selling it, thinking that there's a bearish opportunity at hand, again, it's often quite deep. What draws folks' attention is when the market does not make a new low, but instead turns and starts to rally again. When it breaks out above the top of wave 1, even a technician or someone, a fundamentalist, even who uses a little bit of technical analysis, will recognize that and say, perhaps something else is happening here. And that will make them think that perhaps they need to, 1, reverse course a little bit. Obviously, if this is a correction, it's not complete yet, and maybe there's an opportunity upside. So people start reversing their positions. Now, this recognition of a new trend will come at a different time for different folks, and that will propel a third wave higher and higher and higher. We suggest here it's a powerful wave, usually an impulsive movement, whether up or down. It will be the strongest of the three impulse waves, those being waves 1, 3, and 5. It'll often be, therefore, the longest of those waves. It is the wave that by its end convinces most that the larger trend has changed, that the prior bear trend has been reversed, and the new trend is up, and if I've been left behind, I need to get aboard this trend. Reach a point of optimism, an extreme even, and often there you will see another pause, we call that, will be wave 4, a surprising disappointment, especially for those folks that got involved in wave 3, turn bullish in wave 3 towards the latter half of the movement, because during wave 4, they can find themselves underwater, even though the trend has turned to the upside. So they have a decision to make. And it's that mentality that drives a fourth wave. Often folks will give up. I missed the opportunity. Oh, here we go. That larger bear trend has resumed, only to be disappointed again when wave 5 marches to a new high. Now, usually all the indicators you might follow to measure the strength of these movements, wave 5, will be disappointing relative to wave 3. So, for instance, I will often point to a divergence between price and an RSI indicator to show that wave 5 is weaker than wave 3. And ordinarily, I'll even see the momentum peak not at the end of wave 3, but earlier in wave 3, maybe 3/4 of the way through. And that final top in wave 3 shows a small divergence. After wave 4, that fifth wave will show an even larger divergence, something I'm always looking for. So that is the progression psychologically when we're talking about an impulsive movement. Same thing happens within a corrective. So in the prior slide, there are two corrections visible, wave 2 and wave 4. So this is what goes on, perhaps, within those waves. This shows a simple zigzag. That wave A down, the trend now has been up. That wave A to the downside, people think, oh, if the trend is turned up, I can use this wave A pullback as an opportunity to turn bullish. So when you have wave B, which depending on the pattern, a flat or a zigzag, might or might not move to a new high, and then wave C follows, and wave C breaks beneath the end of wave A, lots of disappointment there, and they'll bail out of those positions. So wave C can often be described similarly to a third wave. So that is the point where folks who thought they missed the opportunity used wave A to turn bullish. In the case of a setback, a corrective setback, they will give up on that, and so that can drive wave C ahead. Now wave B, if it's part of a expanded flat correction or even a flat where wave B goes up and challenges or even exceeds the end of the prior advance, the origin of wave A, that will look like the resumption of that larger rally. And they'll look to jump in. They might get in right at the top only to see the market move back down. So it's a narrow advance as shown here. It can often be quickly reversed because of the psychology at the top. Especially if a double top forms or it gets just above the prior top and then rolls right back over. Particularly then breaks the bottom wave, what we're labeling as wave A. Lots of negative price action going on there. We, on the other hand, look at it favorably. We've counted a 5-wave rally. We're expecting a 3-wave decline, and the market has done so, showing us a 3-wave setback. So we're looking at that as the opportunity. But we waited through the entire 3-wave sequence. So that might be what's going on, an idea of what's going on in traders' minds as you move through a corrective sequence. Now, that would count also for a triangle, though the triangle now, that 3-wave setback shown here, would only be wave A. So you're going to rally in wave B. People start getting excited during wave B. Well, it stalls below usually or just above. Sometimes if it's if it's a running flat, they get excited on that new high, only to see wave C start down again. So it's sort of those same emotions, but it's going to be drawn out in a sideways pattern through 5 3-wave movements. Again, this has all been a review of the very basics of the wave principle. This is the text that got me involved in the wave principle back in the mid-'80s, at the latest 85. I've owned many copies of this book by Frost and Prechter. Hopefully you have read it and read it many times. The information I spoke about here is all found within chapters 1 and 2. That's where the basics are found. Those are the chapters that I read regularly. If I'm leaving on a vacation somewhere and I pack my bag, my reading material, you will find in that bag almost every time this book. After 30 years, I still refer back and will read those first 2 chapters. If you haven't read it, don't think that by reading those 2 chapters, you will be an Elliott wave expert. That will not occur. I remember back all those years ago reading it again, reading it again, over, till it finally started to sink in, make some sense. And when I would start seeing charts, price charts, or looking at the Wall Street Journal or some other financial newspaper, and they'd show charts of housing starts or something like that, I would start seeing these Elliott wave patterns described in the Elliott wave principle in these charts. And it wasn't unusual, if you borrowed my copy of the Wall Street Journal way back then, that if you got to housing claims or something like that, permits or any kind of chart, whenever there was a chart, I always pulled my pen out and started putting labels on it to see if I could see an Elliott wave pattern. Because we use these patterns to track social mood. And that social mood, we believe, is best revealed in prices of traded markets. We started with equities, but we see these patterns in all different asset classes.